Silver just touched $91, and in that exact moment, everything shifted. Not gradually, not with warning, but immediately after that spike, the CME made their move. They tightened margin requirements, raised the cost of holding positions, and added friction to a trade that seconds earlier felt unstoppable. One announcement flipped the entire sentiment from confident momentum to uncertainty and doubt. What looked like a breakout suddenly felt controlled, managed, interrupted. And that's exactly what we need to talk about, because this moment isn't random and it isn't the ending. This is the part of the move where most people get shaken out, right before the real acceleration begins. Understanding what just happened, why it matters, and what comes next could be the difference between capturing a generational move in silver, gold, and mining stocks, or watching from the sidelines while others build serious wealth. Before we go deeper into the mechanics and strategy, I want to address something important. There's a flood of copycat channels lifting original analysis, reposting content, and passing it off as their own work. If you value real research and authentic perspectives, I need your support. Subscribe to this channel and drop a comment with OG John AG right now. That single action sends a signal to the algorithm and helps original voices rise above the recycled noise. I've also created a WhatsApp channel where I share daily market updates, quick observations, and drop new video links before they go public anywhere else. The link is in the description, and joining means you stay ahead of the headlines and the panic. Now let's get into what everyone's talking about, but few people truly understand. Silver didn't casually drift to $91. It surged with the kind of velocity that makes traders pay attention, makes risk managers nervous, and makes exchanges react. And react they did. The CME increased margin requirements, which means holding the same position suddenly costs more capital. This wasn't a suggestion or a gradual adjustment. It was immediate, and it created instant pressure on leveraged positions across the market. Even if you've never traded a futures contract, this affects you because it changes sentiment, influences spot pricing, and alters how institutional money behaves. When margins rise, participation becomes more expensive. Some traders are forced to reduce positions not because their thesis changed, but because they can't afford the new requirements. Others who were considering entering suddenly hesitate because the cost just jumped. This creates a predictable pattern that plays out repeatedly in strong markets. A surge in price, a rule change that adds friction, a wobble that looks like weakness, panic from inexperienced participants, and then a critical decision point. That decision point either confirms a reversal or sets up the next explosive leg higher. The key is recognizing which one you're seeing, and the only way to know is by watching how the market reacts, not what the headlines say. Here's what most people are missing while they stare at price charts asking if they're too late. Being late isn't just about the dollar level. Late is about positioning, narrative, and crowd psychology. Late is when everyone believes the same thing, when mainstream media celebrates the move, when your friends are giving you price targets, and when buying feels safe because it already went up. That's not where we are right now. Right now, the tone is still skeptical. Coverage remains suspicious. Financial networks treat precious metals like they're guilty until proven otherwise. Stocks can grind sideways for months and get praised as resilient, but metals move decisively, and suddenly it's excessive, dangerous, overdone. The message is clear: stay away. And honestly, that's exactly what you want to see in the middle of a major move. The explosive phase doesn't happen when everyone's already in. It happens when the crowd finally capitulates and sprints through the door. If the establishment is still working to keep people on the sidelines, we're not at the end. We're in the messy, volatile middle, where the biggest percentage gains are born and where weak hands get separated from their positions. Silver behaves differently than gold, and understanding that difference is crucial. Gold is a tank, steady and powerful, but not built for the same kind of percentage violence. Silver is both a monetary metal and an industrial commodity. It sits at the intersection of fear and necessity. When money seeks protection and industry needs supply, silver doesn't politely rise. It gaps, it explodes, and then it tries to shake you off the ride. This dual identity is exactly why silver's breakouts feel unfair and why they generate so much emotional reaction. They don't give you time to think. They force you to decide in real time whether you trust your thesis or your fear. Which brings us back to the CME rule change and why it matters. Many people heard rule change and immediately translated it as they stopped the move. But that's a misunderstanding of how markets work. A rule change doesn't cancel a trend. It adds friction. It can force a pullback, create a shakeout, slow momentum, and flush out weak hands. But it doesn't erase the fundamental reasons the move started. Think about it logically. If nothing significant was happening, nobody would bother changing the rules. They adjust rules when pressure builds, when volatility threatens the system, when exposure becomes uncomfortable for the wrong players. So in a strange way, the fact that they reacted is actually confirmation. The move mattered enough to trigger a response from the people who control the infrastructure. Now let's talk about the shakeout, because this is where most retail participants lose money and miss the follow-through. When markets enter breakout phases, they rarely move in straight lines. They do what I call the jiggle, a violent mid-move reversal that looks and feels like the top. It convinces late buyers they made a mistake. It convinces early buyers to lock in profits. It convinces people on the sidelines that the story is finished. Then, once the emotional selling is complete and weak hands are out, the trend resumes and rips higher without them. That's the trap, and the CME margin change is the perfect catalyst to create exactly that kind of trap. It gives the market a reason to wobble. It gives commentators a narrative to amplify. It gives fear a headline. And fear is the most effective tool to separate you from a winning position before the real move unfolds. So what should you actually be watching instead of reacting to headlines? Watch whether dips get bought aggressively. Watch whether silver holds above key breakout zones even if it pulls back temporarily. Watch whether gold remains firm while stocks show signs of exhaustion. Watch whether mining stocks start outperforming the broader market on a relative basis. These relationships reveal where capital is actually flowing, and flow is what drives sustained moves. Because the real story here isn't just about silver in isolation, it's about rotation. We're watching capital slowly but steadily shift away from overcrowded, overvalued trades and toward hard assets. Not everyone is rotating yet, certainly not the general public, but the early institutional flow is visible if you know where to look. The S&P can print new highs while feeling internally weak. It can crawl forward while being in distribution. Meanwhile, gold and silver can surge while still being ignored by most investors. That combination is often the early stage of a regime change. And when regimes change, the gains can be extraordinary for those positioned correctly. One of the cleanest ways to understand silver's potential is to look at it relative to gold. Throughout history, there have been periods where silver commanded a much larger percentage of gold's price than it does during quiet, suppressed periods. Even after a significant run, silver can still be historically cheap relative to gold if that relationship hasn't normalized. And that's why the upside potential can be so dramatic. Not because of speculation or hype, but because mathematical relationships can stretch far beyond what seems reasonable in the moment. Now bring mining stocks into the equation. Miners are the leveraged play that most people either love at the top or hate at the bottom, and they get burned because they trade miners emotionally instead of structurally. Here's the structure you need to understand. The mining sector is tiny compared to the ocean of capital sitting in broad equity indexes. When even a small percentage of that capital rotates out of bloated index exposure and into miners, the mining sector can move like a rocket. That's not speculation. That's supply and demand math. The other structural reality is valuation. For years, mining companies have been priced like a dying industry. Some of that was deserved due to cost inflation, share dilution, and poor management. But prolonged neglect creates enormous opportunity when the cycle turns. So if you're still haunted by memories of miners collapsing during past equity crashes, understand that context matters. The setup depends entirely on relative strength. If miners are breaking higher relative to the broad market, the condition is fundamentally different. It suggests money is actively choosing them, not abandoning them. And that kind of signal often precedes powerful multi-month runs, especially when the underlying metals are strong. Step back and ask the most important foundational question. Why did silver hit $91 in the first place? Markets don't move with that kind of force without reason. Even if you ignore every data point and every technical indicator, you cannot ignore psychology and sentiment. People are exhausted by fake stability. They're watching currency creation accelerate. They're watching debt levels explode. They're watching political and geopolitical risk intensify. They're watching official inflation numbers that don't match their lived reality. In that environment, hard assets stop being a niche hobby and start being a financial lifeboat. That's why the narrative around precious metals is always carefully managed and often hostile. Metals don't just threaten portfolio allocations. They threaten confidence in the currency system itself. A rising metal price is a scoreboard publicly displaying that the currency is losing purchasing power. So the incentives around the conversation are not neutral, which is exactly why you will continue hearing the same recycled phrases. Overbought, excessive, too late, dangerous, bubble. The goal is to create doubt and hesitation before the move matures and before the public gets involved. Here's the critical question that changes everything. What if $91 wasn't the peak? What if $91 was simply the test? Markets frequently spike to prove a level is possible, then slam down hard to scare participants away, then rebuild quietly from a higher base and launch again with even more force. That pattern is older than modern markets. It's how human psychology interacts with price. And the rule change could be exactly the excuse needed for that slam. So if you're waiting for perfect confirmation before you act, understand what confirmation typically looks like. It looks like you buying at a worse price after the public finally believes. It looks like chasing. That's why timing the absolute bottom is less important than recognizing the phase and staying positioned through the noise. Missing the first move doesn't mean missing the entire trend. The larger money is made in the sustained advance, not the initial spike. Let me make this immediately practical with a clear framework. First, expect volatility. If you cannot emotionally handle volatility, you should not be involved in silver directly or indirectly. Second, separate your time frames. Short-term noise is designed specifically to shake you out. Longer-term structure is what builds lasting wealth. Third, watch how the market behaves after the rule change. If it shrugs off the pressure, that's strength. If it dips and gets aggressively bought, that's strength. If it collapses and cannot recover, that's also information. Fourth, watch mining stocks relative to the S&P 500. If miners continue gaining relative ground, the rotation thesis is alive and capital is moving. Now I want to hear from you, and I want real answers in the comments. Do you believe the CME rule changes are simply responsible risk management, or do you think they're designed to protect certain large positions from a runaway market? And if silver does pull back from here in a violent shakeout, will you treat it as opportunity, or will you assume the move is finished? Your perspective influences what I cover next, so share it below. Let's address the too late fear one final time, because it's the psychological trap that costs people the most money. People think late means price is higher than it was, but price is just one dimension. What actually matters is where you are in the adoption curve and the belief cycle. If the general public is still skeptical, if media remains hostile, if the system is tightening rules to slow participation, and if the asset is still fighting for mainstream respect, that is not the late stage. That's the stage where the next major leg typically forms. The most dangerous moment in any breakout is right after a dramatic headline event, because that's when your brain craves certainty. Your brain wants guaranteed clarity, but markets don't reward certainty. They reward those who manage uncertainty better than the crowd. So don't let one rule change convince you the entire story is over. Let the market show you through price action and behavior. If silver stabilizes and continues advancing, the rule change becomes a footnote. If silver shakes out and then rips higher, the rule change becomes the exact reason the crowd got left behind. Either way, you now understand the mechanism, and understanding gives you power. Here's what I need from you right now. Subscribe to this channel, join the WhatsApp community in the description for daily updates and early video access. And if you support original content and real analysis, comment OG John AG so we can push back against copycats and build a community that values truth over noise. The silver story did not end at $91. That was simply the moment the system reacted. The next chapter is how the market responds to that reaction, and that response is where the real move typically reveals itself. When exchanges raise margins, they're essentially saying this market is moving too fast for comfort. Your broker enforces the new requirement immediately, and if you don't have sufficient capital, there's no negotiation. You get a margin call or your position gets reduced. That's why price can drop sharply right after the announcement. Forced selling isn't based on opinion or analysis, it's mechanical. So never confuse a sudden drop with a fundamental change in the larger story. Sometimes nothing changed except leverage got squeezed out of the system. Here's what truly matters going forward. If silver can absorb that squeeze and still hold critical support levels, it tells you the buyers underneath aren't just gamblers riding momentum. They're committed participants who aren't relying on maximum leverage to stay involved. When weak hands get forced out, the next push higher can actually be cleaner and more sustainable because the market isn't loaded with participants who panic at the first sign of trouble. There's another important dynamic. Rule changes like this often push people away from paper exposure and toward physical ownership or longer-term strategic positioning, because nobody enjoys playing a game where the cost of participation changes overnight without warning. That shift doesn't always show up instantly in price, but when it does manifest, It tightens the real-world physical market over time, creating supply pressure that can fuel the next surge. Watch sentiment closely. Pay attention to how people talk, what they fear, and what they're quietly accumulating while publicly claiming they're waiting for a better entry. That's where future moves leave clues before the chart confirms anything. Because the next major surprise might not be a gentle new high. It might be a gap that leaves people behind. It might be a weekend headline that changes everything. It might be a sudden shortage narrative that emerges after everyone relaxed. And if that happens, the people who hesitated because they wanted one more perfect dip will find themselves chasing at much higher prices. So I'll say it clearly one more time. The question isn't whether you bought the absolute bottom. The question is whether you can recognize what phase you're in and whether you can remain calm and rational when the chart tries to intimidate you. Stay sharp, stay patient, and watch the reaction. Because the reaction is always where the truth hides and where the next major move begins to take shape.